I'm David Watts. I'm the European credit strategist for CreditSights in Europe. I've been with the company 10 years now, and for almost all of that period, there's been big macro factors that have driven performance in credit, and none of them have been explicitly credit fundamentals. So back in 2004, we had the re-emergence of cash CDO issuance, and we had the introduction of a standardized credit index that was tradable based on CDS, the iTraxx. We started seeing a great deal of leveraging of exposure to credit based on the iTraxx throughout 2004 and into 2005. And by 2005, we had the correlation crisis, which looking back looks like a small blip on this chart, but at the time was a big scare. It was based on the fact that GM and Ford were downgraded and disrupted people's models for how they were assessing default correlation. We quickly recovered from that, we rolled forward, and we started to see the evolution of a whole range of structured products. CPDOs, CPPIs, leveraged super senior, rated equity, all of them designed to allow investors to take additional exposure to credit. And then in 2007, we had the sell-off in the ABX. That's an index that references via CDS a range of residential mortgage-backed securities, subprime mortgages. And that gave us the first signs of problems in the US subprime market. And that then developed, of course, into a global financial crisis. That then developed into quantitative easing, unlimited provision of liquidity by the ECB, and other monetary policy actions. The damage from banks' balance sheets and the uncertainty about whether or not euro area governments had access to a lender of last resort then transmogrified from there into a sovereign crisis and into the scope and ability of the ECB. Now, looking back across all of those, I remember the conversations that I had with clients. They were all based on explanation. What are CDS? What are CPDOs? What are subprime mortgages? And also to expectations. What are US defaults going to do? What's the ECB going to do? And then we rolled through 2013, and we started to buy into the idea that the ECB could contain the crisis and backstop the funding of governments. And then the question increasingly focused on the low yield environment. And a question in two forms. There was the inevitable question, when are yields going to back up? We just had the taper tantrum, a big scare, back up in yields in May 2013. And the expectation was that given that yields were still very low, they would probably go higher. And the second question was, how do you make returns in a low yield environment? And it was that question that provided me with a revelation. Now, I know this probably sounds obvious to everybody else in the room, and if it does, I apologize. But we get fixated as a result of the media focusing on who predicted the subprime crisis, the woman that predicted the financial crisis. Did you get the call right on gold? Timestamp on Twitter. And yet, when people are looking for our advice, they don't necessarily look to us to have the exact call on yields. In reality, a call on yields is, in their view, a 50-50 call. I mean, let's take, for example, the call at the beginning of last year. The natural inclination would have been to shorten duration. It looks very asymmetric. Yields can only go higher from here. And let's say that had been the right call. It wasn't, but let's say it was. Well, regardless of how much work I put into making that call and how well I understood government yields, from the investor's perspective, I had a 50-50 chance of getting it right. Is he necessarily going to stake his portfolio on my call? And is he necessarily going to subscribe to my service next year based on last year's call? The other problem with it is, of course, it turned out to be wrong. And actually, from a credit investor's perspective, the European Credit Index is somewhat peculiar. This chart illustrates the extent to which credit for investment-grade corporates in Europe lies on the steepest part of the government curve at the moment. If you roll into a short duration position, you give up carry. The yields are much lower. But the other problem is that you miss out on roll down. Roll down is that you're discounting the bond by a high yield, and as it matures through time, you're now discounting it by a lower yield. Okay, you take a coupon off, count that as return, but you also now have a lower discount rate for the remaining cash flows, and that means that the price depreciation from taking the coupon off is much smaller. That's valuable. That's very valuable in a low return environment. So what I increasingly started to perceive was more valuable last year for investors was not trying to call yields, the timing or the level, but actually to ask them what their expectation for yields were. And if they didn't have a near-term expectation for a backup in the yield curve, then it seemed advisable to me that they should remain duration neutral versus the index, enjoy the carry, and receive the roll down. Okay, but you're still exposed to the asymmetry. Yields were very low and they were increasingly low. They're now, for the effective yield on the German government index, at 15 basis points. They can only go higher, right? Well, they could only go higher at 35 basis points back in December. So now they can only go higher even more so that we're at 15. But the problem with that is it still ignores the returns from remaining duration neutral. So how do you deal with that? Well, one of the ways that we try to propose a solution is by increasing the flexibility in the portfolio and increasing its ability to be able to take advantage of a rise in yields. High coupon bonds are anathema to corporate bond investors. For high-grade investors, just the mere idea of paying more than you're going to receive back at maturity is a deep-rooted turnoff. In addition to that, some accounts have tax implications from high coupon bonds because they're trading at a premium to par. And for high yield, with calls and defaults, then the losses if the bond is called or it does default are much larger if they're at a premium. But if you buy a high coupon bond, you throw more of the expected return onto the reinvestment component. All of those cash flows are now available to be reinvested if yields do back up. If they don't, what's your downside? Okay, you might reinvest them at a slightly lower yield, but we're already agreed that yields are somewhat asymmetrical at their low levels now. This isn't about making a prediction, this is just an observation. You can increase the flexibility of your portfolio and increase your ability to respond to a high yield environment by changing the instruments you're looking at. And so now what I try to do when I'm thinking about my clients is not, can I make the call right? Can I better predict what's going to happen? Because I actually think that a good portfolio manager isn't the one who gets the call. He's the one whose portfolio still performs relatively well, even when his predictions don't prove to be accurate. So what about the economy? Well, everybody's got a view on the economy, and investors are always happy to hear the view. Will they pay for my view? Well, my view is that the economy will continue to be relatively weak versus pre-crisis growth levels. There's asymmetries in debt. That means that there's a difficulty in returning to pre-crisis consumption rates that were driven out of those stressed countries. And there's also, of course, the continuing drag from fiscal consolidation. But people aren't going to pay for my view on that. We've got economists in the room who are going to be able to better provide that kind of analysis. So instead, I try to focus on what sort of instruments will perform well in different environments, and what instruments ought to perform better in the most environments. Now, we think that the economy is going to stay weak, therefore we have a preference for taking exposure to companies that are less economically sensitive, to moving into non-cyclicals. Well, in credit, of course, moving into defensives means that you're going to get a spread sacrifice. But the non-cyclicals, the telecoms and utilities particularly, have been big issuers of subordinated bonds in the past 5 years. Those instruments provide a very big spread pickup compared to the senior bonds of non-defensive companies, of the cyclicals like retailers. And yet the retailers are the ones that are seeing the real pressures, in high yield particularly, but of course the downgrade of Tesco's illustrates the problems being faced by the national champions in Europe. What's more, the interesting thing about these subordinated bonds is that when we've seen changes in government yields, they've been far less price sensitive than the senior bonds. That's because there's some perceived early call risk, but that early call risk is incredibly valuable from an investor's perspective. It reduces your sensitivity to underlying government bonds, and therefore it means that even if growth does pick up, and we're wrong in our call, and the yield curve starts to back up, you actually may be less exposed by having the subordinated bonds. It is, of course, the play on exploiting the companies that are taking advantage of low-cost financing. If that goes away, this may change. But the reality is that telecoms and utilities are big companies with myriad access to financing. They've got bank lines, they've got senior bank bonds, and these are just an arbitrage on the low cost of subordinated bonds at the moment. What about event risk? Investment-grade corporate bond investors are always worried about event risk, and they're particularly worried when debt financing costs are low. Well, here, we think you should be looking to sectors that have regulatory requirements for their existing leverage, banks and insurers. Or, going back to the utilities of the telecoms, they've demonstrated a dedication to a senior rating that is investment grade since the development of the euro corporate bond market. They're already maximising their capital structure optimization within the constraints of those senior debt ratings. And so those companies are both too big to LBO and also have already maximised the extent to which they can reduce reliance on equity funding. So it just shows the spread curve for the euro area corporate bonds, and it shows the extent to which it's steepened since the ECB has introduced new policy measures in June last year. And the curve steepened pretty dramatically at the short end. That's primarily, I think, because people expect banks to start buying high-rated, short-dated corporates in an effort to pass on excess reserves created by quantitative easing and other programs. Well, once that starts, that should start to see some investor migration out to the longer end of the curve. That, I think, is an attractive way of exploiting a spread pickup. Okay, if you do get a parallel shift wider in spreads, then you'll get larger losses on those long spread duration sectors. But the reality is that the spread curve is very steep historically at the moment. And unless we see a parallel shift out from here, what's more likely, I think, is either that the short end normalizes because banks don't buy high-grade corporate bonds, or that the long end does tighten as we start to see investors shift. This comes to the final point that I'm going to make, and then I'm going to try and wrap this up with a conclusion. The one conversation that we've reliably had in every client meeting since last summer has been the question of liquidity. And this chart tries to illustrate the extent to which corporate bonds are at the moment pricing in a premium for more liquid instruments. It shows the difference between the spread on large-size senior investment-grade corporate bonds and smaller bonds, those of less than 750 million euros. And the difference in spreads has increased from 6 basis points in February last year to a high of 14 basis points after the US Treasury flash crash in October. It's recovered somewhat to slightly under 10 basis points, but it's still at 12 basis points. Now that's a sort of interesting observation, but it doesn't really help me make any predictions. I can't tell you that 12 basis points is more than you should have for the illiquidity that you face. I don't know whether or not trading conditions are going to be sufficiently bad that you should actually be compensated more than that. What I do know, though, is that investors are deeply concerned about illiquidity. They're deeply concerned about redemptions after the taper tantrum, and also they face some redemptions on accounts through 2014 as well. Instead of moving a large portion of the portfolio into cash and trying to counter that liquidity concern, you should consider moving a portion of the portfolio into more liquid bonds like senior bank bonds, or in high yield into fallen angels. Now those bonds still generate a spread sacrifice versus the index, but the reason they're attractive is because the spread sacrifice is much smaller versus cash. And in addition, the duration distortion is also much less. Now the reason that this is important, and it brings me to the end of the presentation, is because it's about portfolio construction. It's not about throwing all your eggs into one basket. It's about considering different portions of the portfolio and what requirements they're trying to fulfill. If you're worried about liquidity, or if your client is worried about liquidity, then there are measures they can take to try to mitigate those risks. And so to try and wrap up, I'm going to close on 2 comments that helped me to come to my change in perception of what I should be doing as a strategist last year. The first was that there are 2 types of people in finance. There are people that pay fees and there are people that receive fees. And the people that receive fees are the only ones that reliably outperform. Now, to a room of independent research providers, that can leave us with a smug feeling. But actually, I think we should take it as some kind of indication of what we should be thinking about in terms of our clients. We should be helping our clients to reliably outperform. Just by a little bit, not by big home runs swinging for the fence. We should be thinking, how can we help them construct their portfolio in such a way that even if the core scenarios are wrong, then it still performs slightly better than the average. And the second piece of advice that I was given last year was that, I forgot my second piece of advice. That's a classic presentation. Sorry, that's a good touch. Yes, it's less profound than it's going to sound now. The second piece of advice that I was given was that most fund managers don't fail because they're not good stock pickers. They fail because they fail at portfolio construction. They fail to build a portfolio that's able to weather different outcomes. And so let's not try to provide our clients with short-term trades based on the latest data release. Let's instead try to think about how we can help them to weather all of the eventualities, even if they get the base call wrong. Thanks very much.
Thanks, Dave. Very good presentation. I did exactly that on CNBC the other day, actually. Easily done. Like many economists, my approach to valuing assets is going to be based on long-run fundamentals. But funnily enough, I've actually always really enjoyed working with some of these sort of macro hedge fund guys, especially in what I've done in the last few years is sometimes on distressed assets, where they often they generate alpha just by being really, really fantastic at getting the next trigger right. And sometimes I could have a conversation with these guys and we'd agree on everything, including to buy or sell, and sometimes we could agree on everything except whether to buy or sell the thing. And I've always wanted a framework. I kind of understand why that is, and I've always wanted a framework that could encompass both views, and I kind of think I've got it here. So my goal over the next few minutes is kind of show you that framework and also to give you some insights on Greece, really focusing on, I think, on the deeper incentives facing both Greece and the Eurozone. So just to start off with, and I think Mark Sturdy from the last presentation had a field day on this one in terms of Chartist. This is just the average price of what's known as a strip, which is commonly traded for Greek government bonds. It's the average of 20 bonds that emerged from the restructuring maturities 2023 to 2042. And you can see that it just recently has gone all over the place. It collapsed as Syriza gained strength late last year, and does this work? Probably does, but it doesn't matter. Anyway, you can see recently, I'm going to focus on the recent events, just how volatile that has been around whether they get the extension, whether they call it an extension, whatever. And that is going to be a focus of what I will say today. But to give my framework, I always like it if I can do risk-based analysis. So I love it if I can do a scenario tree. I've got one here. I've put it in 3 stages. The stage whether you agree a program or agree an extension, whether you actually can implement the program, and then the end games. The end games can go all the way from a chaotic exit for Greece on the downside, right the way to some wonderful scenario for GGB holders where the official sector gives lots of debt relief and we all live happily ever after, if you're a bond holder. And the current price is going to be just the probability weighted average of all the end games. And I think that's how you should value these bonds. I'll return to this later. But I did say I wanted to really dig into the deeper incentives facing Greece. And there's 2 ways of looking at this. Now, what we have here is nominal GDP projections by the International Monetary Fund, actually their September projections, which are the most recent. And what you can see here, it just says, oh, Greece, what have you done? You were on top of it. You were going to be the best performing in terms of nominal GDP out of all of the Eurozone. You've done all the hard work, you've given it away, you idiots. And there you see Greece at the top of the pile. Greece, of course, it kind of faces a love versus hate decision. You know, it loves the euro, Greeks love the euro, and hate austerity, and that's the essential dilemma here. And here's another way of looking at it. As economists will, and others who are familiar with adaptive expectations, we look back a bit, and this is probably what a lot of Greeks think about. This is the Greek GDP, backward looking, 2009 equals 100. And you can see Greece just way outnumbered and isolated, just like in Eurozone meetings. And they are because they are. And what you can see is that all this fall in GDP took place within the Troika program. The Troika carelessly lost 27% of Greek GDP in revising its forecasts. That's the equivalent in US terms of losing New York, California and Florida. And how can you possibly do any reasonable fiscal programming against that background? Another thing to add might be that, well, actually, if you look at Greek households at the moment, believe it or not, 10% don't have electricity in the Eurozone. That's why Syriza gets in. And that's why Syriza is popular. And here is, this is a labour of love. I've done each opinion poll for the last couple of years, typed in by hand from the Greek. And what you can see here is just amazing increase in support for Syriza. The last one is post-election. And the big question, though, is not really whether Syriza have got the report. Of course they have. The big question is what happens when they get into the implementation stage. And the one industry in Greece, actually, which is probably competitive, asks all the right questions, and low cost, is pollsters. There's loads of them. They ask every question. And one of the questions I asked them after the elections was, what if the talks don't deliver a positive conclusion for Greece, which is kind of what you really want to know. And 64% thought Greece should not examine euro exit, while 30% thought it should. And I guess that's the case for still buying GBBs. Syriza have done exactly as Electra wanted. They bargained hard and then they caved in. Going forward, it gets much more complicated in the implementation stage. And I wanted to look at the deeper incentives there. First of all, incentives to stay. Now, I'm not really going to go into those for time constraints. I just really want to put this slide up to say I'm not just one-sided. There are absolutely huge incentives to stay. And one thing I would say is it's very hard to get them as an Anglo-Saxon. You know, we kind of don't have that love of the euro that Greeks and many in the periphery do. But I'm going to dwell a bit more on the incentives to exit. I mean, I do love this chart. It's one of my favourites. I mean, there's so many dimensions to it. What it shows is the ratio of deposits to GDP into probably the most famous sovereign crises in history, Greece and Argentina. And they both, the end of the chart is zero, which in Argentina is the start of 2001 when they exited the currency board. In Greece, it's actually just now, basically, if they had have exited. Now, Argentina, this, in the record books, was really one of the most important cases of deposit flight at that point. 8% of deposits left the banking system in the run-up to the exit. In Greece, so sorry, not 8%, 8% of GDP, I should say. In Greece, 50% of GDP. 50% of GDP. So it's over 6 times that in Argentina. And the basic reason is, you know, in Argentinian deposits could drain central bank reserves and the IMF program money. Greeks had the entire stock of ECB tolerance limits, and they've used them pretty well, actually. So 50% of Greek GDP, as much as, could be safe if Greek exits. And the thing actually is that if you get an exit and you get a big depreciation, you know, some people say 50% depreciation, that 50% of GDP could become, you know, up to 100% of GDP. It's an enormous stock of money which is just waiting to come back, picking up assets. And on top of that, I used to, you know, take the hedgies, distressed investors, down to Athens for a living quite often. And my word, those guys are very sharp and they're very good at spotting bargains. So I figure after a period of utter horrible dislocation in Greece, that within 6 months, you'd get quite a big rebound in asset prices that would eventually lead to the rest of the economy. Greeks, maybe the debate doesn't focus on that, but if push comes to shove, it does. Another big incentive to exit, it's all about debt in the end, and the amount of debt relief that Greece would get if it exited would be astronomical. I reckon 143% of GDP. And it's quite easy to calculate. You just take a standard IMF approach. You start with a GDP ratio, 175. You add on a big bill for recapitalising the banks. You add on the effects of depreciation. You easily get the post-exit GDP to debt to GDP ratio of 270 plus, 273 I've got there. IMF would typically come in with a target of 130. Bob's your uncle. Sorry if that's back of the envelope and very quick, but the message is huge debt relief. Greece would get what it wants, and there's really very little the Eurozone could do about it. Then you get competitiveness gains. I won't go into those for time reasons. But, okay, 4 judgments on Greece. Actually, well, now I guess it's a 9. I mean, the probability of the program getting extended, I've got 98% there. In a minute, I'm going to work with 90 for the reasons, calculations I did last week. It's not clear what they've extended. The banks are still open. That's about it, I think. But so they get the extension. So I'm really cautiously pessimistic, actually, that new program is going to stay on track. I've got a 45% probability of it going badly off track, leading to capital controls. I mean, this is Syriza having to implement the stuff that they were only recently demonstrating against. I mean, it's hard to imagine it going well. It might go well, though. Next, if they do go into capital controls, at that point, it does get really complicated. I think a 50% chance of exit, even at that point. But the reason is Syriza will probably have a referendum, have to do it really quickly because the whole financial system would be falling apart. Now, probably Greeks would still vote to stay in, but you might have just unleashed a train of events, with German popular opinion being quite hard, that you just couldn't come back from. So I'm going for 50% there. And finally, the price of GGBs, I've done that calculations in the background based on the previous chart of what would happen to Greek haircuts. I think the GGB price would go down below 15 probably, somewhere between 12 and 17. And this is kind of the scenario tree in its full illegible glory, but I just want to really focus on how it looked like. The message is that what I need to do is to put values on all the end games, probabilities right the way through, and then I can back out what I think is fair value for GGBs. But the beauty of all this is I can twiddle with these probabilities, twiddle with things, to see how I think in a fundamental sense bonds should respond to events, and how that compares to how they do respond to events. This is where I kind of marry up my framework with what these macro hedges sometimes do. So I'm going to focus on the blue box in that one, just blowing it up a bit so hopefully you can see it. There are 3 things on this chart. So I have, this is given before the agreement, I had an 80% probability of agreement. So at that point I was a 50.6 fair valuation on the 2032 GGB, and there was capital controls, 51%, probability of exit, 25%. Now I'm just going to, sorry, that was halfway through the negotiation, so that was on a 90% exit probability. 80% I was a little bit, obviously less chance of they're getting agreement. So basically this was, almost 2 weeks ago, and then last Friday, things were getting more optimistic. The price, I think, of fair value of GGBs went up, you can see in the red, 48.4 to 50.6, 4.5% gain. Now what actually happened to GGBs at that time was you got a 7.5% gain in the short term, and then it went up to 13%. So basically, markets reacted more than fundamentals. I guess that's just no surprise. But quite money spinning for those that macro hedges, and I think quite a few of them would have put some bets or taken hedges off at that point. So I think that probably is how I marry up the frameworks. I just want to say a couple of things about the way forward. First of all, the way the debt sustainability analysis goes, these are charts of the blue bars you see there, primary deficit prior to this Syriza getting in, the projections. And you can see that that was enough just to get the debt GDP ratio on the right track. 2 points on that. One, if you reduce the primary deficit to what Syriza wants, that line, the debt GDP ratio, doesn't go down anymore. That's a problem. Second one, if it doesn't go down anymore, they need new money, and they need a new programme, and they need to get it through the German parliament. So that's a problem as well, a really big one. So I think obviously there was a bit of a ebullience at the agreement, but there's a lot of problems still ahead. The next one I just want to show you is the implications of contagion. So Oxford Economics, we are nothing if we're not simulators. We have a huge macroeconomic model. We like to simulate as much as possible, run off scenarios, derive our asset views from those scenarios. This is a scenario of a Greek exit. I'm just going to show you, give you a real flavour of it. What we think would happen is that you would get some increase, or in this scenario, you get some increase in bond spreads, some fall in confidence. That would reduce euro area GDP growth going forward. And you have to remember that things are on a knife edge in Europe. So in this scenario, it would be enough to flip Italian GDP again from a downward trajectory to an upward one. And to me, the narrative actually comes as well in terms of political contagion. So I think that the real worry here is that Europe just doesn't have any shock absorber room anymore. It's all gone. And if you do get more populism getting in Spain or Portugal or Italy, you are going to see debt just carrying on quite a negative trajectory unless you do get this turnaround in GDP pretty quickly. So to summarise, what I would like to say, I hope I've given you a taster, not just of our views on Greece, but how we at Oxford Economics like to think about valuing assets across different scenarios, across different frameworks. And I think for us that's the way forward. But I guess if there's one thought I'd leave you with, it kind of is to bow down in a way in front of the macro hedge guys, fund guys. It's not, I actually have Greek government bonds significantly overvalued, according to these analyses. But in a way, that's not too surprising. To tell you that a risk asset, the risk is too expensive, I think would ring a bell with many people in this room. It's QE in a way, isn't it? Obviously. But in that environment, no wonder some of these macro hedge fund guys find the best way to generate alpha is just being really, really good at generating views on triggers and how markets are going to react to triggers rather than taking a view on long-run fundamentals. Thank you very much.